Okay, let's just jump right in because the headline numbers we're looking at today are, well, they're honestly a little counterintuitive.
They really are.
Usually, when we sit down to talk about these huge companies, and I mean, let's be clear, we're talking about UnitedHealth Group, a behemoth that practically is the healthcare system.
Yeah.
The story is always more.
More revenue, more customers, a bigger footprint. That's the traditional narrative, absolutely.
The arrow is supposed to go up and to the right. That's
Yeah.
the standard capitalist playbook.
Especially for a company like UnitedHealth that's been, a growth machine for decades. You expect them to come out and say, we conquered 5 new states.
Exactly. But then you open this earnings report from January 27, 2026, and you see something that makes you do a double take. UnitedHealth Group is practically announcing, hey, everyone, our plan for 2026 is to get smaller. They're projecting their revenue to actually drop. We're talking about going from nearly $448 billion in 2025 down to around $439 billion in 2026.
It is a striking pivot. I've been analyzing corporate strategy for a long time, and it's rare to see a giant of this size intentionally hit the brakes.
And that's exactly why we're doing this deep dive. Our mission isn't just to read numbers off a spreadsheet. It's to understand what this strategy, what they're basically calling shrink to grow, what does it actually mean for the U.S. healthcare system?
And for anyone holding an insurance card. Because if the biggest player is shrinking, that sends ripples everywhere.
Right. So to set the scene for everyone listening, we're pulling directly from the primary sources. The UnitedHealth Group Q4 2025 earnings report, the conference call transcript from that same day, January 27, and all the financial tables.
And if you want a core theme for this deep dive, write this down. Right sizing. For years, the mandate in healthcare was a land grab, get as many members as you can. What we're seeing here is a hard shift to margin recovery, discipline, and frankly, clearing the decks after what sounded like a very tough, very messy 2025.
Clearing the decks is a polite way of putting it. I was reading through the Q4 recap, and it sounded chaotic. They took a massive financial hit, a charge, I think they called it.
Yeah, a charge of $1.6 billion. Net of tax.
Okay, $1.6 billion. That is not pocket change. What is inside that number? It sounds like they just dumped all their bad news into one bucket.
That's essentially what clearing the decks means. If we break it down, there are 3 main components. First, they're still paying for the massive cyber attack from back in 2024.
The ghost of cyberattacks passed. I remember that. It paralyzed pharmacies.
Exactly, and financially, it's still haunting them. There was a true-up of about $800 million related to that. Basically, they're acknowledging some loans they made to providers won't be paid back.
So they're just writing it off. Okay, that's half of it. What else?
Then there's a gain, about $440 million, from exiting some businesses in South America, which offsets things a bit. But the big one, the one that really signals this whole strategy shift, is a restructuring charge.
It's inside that.
A $625 million lost contract reserve.
Lost contract reserve. That sounds like corporate speak for. We signed some deals that we really, really regret.
That's a pretty good way to put it. They have contracts probably in their Optum business that are structurally unprofitable. They're losing money on them every day.
So it's like ripping off the Band-Aid. Take all the pain in Q4 2025 so you can look clean and profitable starting 2026.
Precisely. And it's important to note, the CFO emphasized this is largely non-cash. They're not writing a check. It's a bookkeeping move.
And what's wild is that even with all that noise,
Yeah.
they still beat expectations.
He did. Adjusted earnings per share was $16.35, and revenue for the full year still grew 12% to that $447.6 billion number.
Which is just, it's a huge number. But that's 2025. The real story here, the part that you really need to grasp, is the pivot for 2026.
Yes, the membership contraction, that's the headline.
UnitedHealthcare expects to lose between 2.3 and 2.8 million members in 2026. Maybe just pause on that. That is the population of Chicago, just gone from their books. Wow.
Because those customers cost too much to keep. This is where the business logic gets very cold and very clear. The biggest driver here is Medicare Advantage.
Wait, Medicare Advantage, that's been the golden goose for years. Why are they suddenly shedding over 1 million seniors?
2 things collided: utilization and regulation. On the utilization side, you know how often people go to the doctor, the trend is way up. Medical costs rose about 7.5% in 2025.
Okay,
For 2026, they're projecting a 10% cost trend.
10%. That seems massive.
It is a massive jump. People are getting more hip replacements, seeing more specialists. The cost to treat these seniors is just skyrocketing.
So grandma's going to the doctor more, and the insurance company is footing the bill.
Right. And at the exact same time, the government, CMS, has been tightening the funding. The payment rates just aren't keeping up with that 10% medical inflation. The math doesn't work.
So their strategy was, what? Repricing.
Repricing, which means raising premiums and cutting benefits. They knew exactly what they were doing.
They knew that if they did that, people would leave.
They were okay with that. They explicitly prioritized margin recovery over membership growth. They're targeting about a 50 basis point improvement in their Medicare margins.
So they looked at those 1.4 million seniors and said, if we can't, and it sounds like Optum Health also had a bit of a rough finish to 2025.
They did. They missed expectations, largely due to that restructuring we talked about. But their strategy for 2026 is what they're calling back to basics.
Back to basics. What does that mean? Are they doing house calls with a black bag?
Not quite. It means focusing intensely on value-based care, VBC. Getting paid for outcomes, keeping people healthy, not just for every single test and visit.
Right. Fee for service versus value.
Exactly. And Patrick Conway, the Optum CEO, he gave a really specific example. He talked about their Texas market.
I saw that. They have, what, 750,000 patients there?
Huge sample size. And in that market where they've fully deployed this value-based model, they're seeing the total cost of care run 30% better than their competitors.
30%. That is a staggering number.
It is. And here's the kicker. Their net promoter score, which is, customer happiness, is near 90.
Which for healthcare is.
Yeah.
It's unheard of.
But to do that, you have to be incredibly disciplined about who's in your network. And here's another surprising stat. Optum narrowed its affiliated network by nearly 20% last year.
Wait, they cut 1 in 5 of their doctors.
They cut unaligned contracts. Basically, if a provider wasn't playing ball with the value-based model, if they were just churning out volume, Optum cut them loose. Again, it's quality over quantity.
It's ruthless efficiency.
Right.
What about the pharmacy side, Optum Rx?
Well, they're under a lot of pressure, politically and socially, but Optum Rx actually had a strong selling season. They went out and won 800 new external clients.
So they backfilled about half the membership loss from the insurance side.
Yeah, impressive sales work. And they were really pushing the transparency angle.
They have to.
They do. So they announced they're removing reauthorization requirements for 180 different drugs.
Which is a huge annoyance for patients. Doctor says, I need it. Insurance says, let me think about it.
Exactly. And they committed to passing through 100% of drug rebates to customers by 2028.
That's big. The rebate game has been a black box forever. Okay, but there was another Optum piece. They're merging Optum Financial with Optum Insight.
Yes, this is a strategic alignment. Insight is their data and tech arm. Financial handles the payments.
So putting them together.
The goal is real-time point-of-care approval and monetization.
Okay, let me try an analogy. Right now, going to the doctor is like getting a bill in the mail a month later that you don't understand. They want to make it like a coffee shop where you just tap your card and you're done.
That is a perfect analogy. And to do that, you need the clinical data from Insight and the banking rails from Financial talking to each other instantly.
And speaking of efficiency, we have to talk about AI. Was this just hype, or are they actually doing something with it?
It definitely wasn't just hype. They put a price tag on it. They plan to invest nearly $1.5 billion in tech and AI in 2026.
Okay.
But more importantly, they quantified the savings. They expect nearly $1 billion in AI-enabled operating cost savings this year.
Spend $1.5 billion to save $1 billion in year one. That's a pretty good return. Where is that coming from?
Nothing too sci-fi. It's call centers. Over 80% of member calls now leverage AI tools, not to replace the human, but to give the human agent the answer instantly.
Oh, thank goodness. If AI can kill hold music, I'm all for it.
But here's the key. You can't use AI if your data is a mess. Conway mentioned that Optum Health moved from using 18 different electronic medical record systems down to just 3.
18. That's a data nightmare.
It is. By standardizing, the AI suddenly has a consistent data set to learn from, and that efficiency is crucial. Remember, revenue is shrinking. The only way to keep your profit margin up is to slash costs. AI is the scalpel.
So the strategy is fire unprofitable customers to fix the top line and use AI to slash costs to fix the bottom line.
That's a very astute summary, but they are facing some strong headwinds. We need to talk about the government.
Right. The advance notice. It sounds ominous.
It is, for them. The night before this call, CMS released its advance notice for 2027 Medicare rates.
And I take it the news wasn't good.
It indicates further funding cuts. Management called it disappointing, and said it doesn't reflect the reality of medical costs.
So 2026 is a year of shrinking. And the government is already signaling 2027 might be even tighter.
Correct. And that could lead to more footprint changes in 2027. That's code for we might pull out of even more counties.
It feels like a game of chicken between the insurers and the government, with seniors stuck in the middle.
And that dynamic is why trust is such a huge issue. The CEO did emphasize a new transparency push. Starting in 2026, they're promising to publish their data on prior authorizations, claim approval rates, things like that.
They're basically saying, look, we know you don't trust us. Here is the data.
They're trying to rebuild that social contract. Whether a few charts will do it remains to be seen.
So let's wrap this up. We wanted to understand the right sizing of 2026. The takeaway is that the growth at all costs era might be over.
It might be. The focus now is on execution, efficiency, and margins. They're guiding to $439 billion in revenue and earnings per share over $17.75. To hit that, they have to execute perfectly on this contraction.
It's a pivot point. We are watching a giant learn to dance in a smaller room.
And as we wrap up, I want to leave you with a thought. We talked about UnitedHealth shedding, nearly 3 million members to restore profitability?
Right, cleaning up the books.
But here's the question. If the largest, most data-rich, most efficient healthcare company in the United States cannot make the math work to insure those 3 million people, where do they go?
That is a heavy question.
If efficiency in our system essentially equals exclusion, if the only way to be a healthy business is to stop covering the people who need the most care, what does that say about the sustainability of the broader system we might be watching the safety net fray?
Wow. Yeah. It's one thing to see membership contraction on a spreadsheet. It's another to think about 3 million people looking for a new insurance card. That is something to chew on.
It certainly is.
Well, on that slightly terrifying but incredibly important note, we're going to wrap up this deep dive. Thank you for listening, and thanks for letting us unpack this with you.
Always a pleasure to connect the dots.
We'll catch you on the next one. Stay curious.